This is the Ecommerce Braintrust, a podcast about building momentum online for established consumer brands. Join our hosts and their expert guests for high-level conversations about e-commerce strategies, trends, and innovations. Access our Braintrust and boost your brand's e-commerce potential.
Welcome to the Ecommerce Braintrust podcast. I'm Julie Spear, Head of Retail Marketplace Services at Acadia. And today I'm joined by Claire McBride, the VP of Research and Education at Stratably. We'll be diving into the Amazon Vendor Negotiation Benchmark report that Claire authored alongside Martin Hubel of Consultors, and some of the key takeaways that you can use both for benchmarking your Amazon negotiations against the industry at large, as well as guidance for starting to prepare for next year's AVNs. So with that, welcome, Claire. It's great to have you on the podcast.
Thanks, Julie. So glad to be here.
And I'd be remiss if I didn't call out that Claire and I are both Clevelanders. So it was nice connecting with another local before we started the conversation today.
That's right. Next time we should do it live on that couch behind you, Julie.
Right. Or down by down at the lake, something. We got to give a little Cleveland flair to it next time.
Totally. Love that idea.
Digging into the report, for a lot of brands, AVNs can be stressful. They lack a little transparency. There's some mystery around them. Amazon's not always clear on what brands can and can't negotiate, which terms are held fast to. You have to do your own research to understand what's at play, where to focus as a leader when you're negotiating with Amazon. Can you talk about what you set out to do with this benchmark report? I'm wondering if there are certain areas of confusion or lack of knowledge that you hear often from the brands that you talk to, and you were hoping to clear those up with this report.
Yeah, absolutely. AVNs are a critical element to the Amazon business, of course, right? It's influencing much of the brand's P&L. It's leading to new investments that may or may not yield an ROI for the brand. Hopefully they do. But you add in that nuance that Amazon, to your point, is a little bit mysterious. They're a very unique and tough negotiator. So most brands said, hey, AVNs were challenging this year. That is not surprising. And so it's very high stakes for the brand. And therefore, any Amazon leader is going to want as much intel as possible to inform those negotiating strategies. I mean, when we're in business because brands are hungry for data regarding Amazon, among other retailers, but what is the retailer doing? What are their peers doing? What can I expect? How can I get ahead? And I think AVN is one of those topics where it is just so high stakes. It's stressful. It can be mysterious. And so brands are really eager to get their hands on as much data as they can around the whole process. With that being said, Amazon holds a lot to their chest, of course, and negotiations inherently are a sensitive topic. And so while brands are hungry for this information, you're not really going to find a ton of specifics, throughout the industry, the same way that you might see a ton on like Amazon advertising strategies as you scroll through LinkedIn or something like that. So what we're solving for with the benchmark is we want to bring more signal to the brand leaders that are going through a very critical piece of the business. And with the benchmark, we can do it in an anonymous way, a very scaled way, and thoughtful way to provide brands, that intel into their peers' experiences as they're really hungry for all of that information.
Yeah, it's so important. And I was actually just meeting with a brand yesterday where they want something to measure against. Is this just our experience with AVNs, or are there others? And so I actually referred to your report yesterday when I was talking with one of our clients, because it is just important to tie yourself, to have something to like anchor yourself against, to understand what's the norm. And when you understand a little bit about the norm, then you can see how you can enter into the negotiations. So I think this
Absolutely.
Is much, much needed. On that though, how did you go about gathering the data? What's the outline of who you spoke to, where they're based, the company size, categories that you dug into? Who did you go to get this insight and intel?
Yes, a very wide range. So as you mentioned, we partnered with Consultancy on this study, which is a strategy consultancy that helps brands through AVNs and other parts of the Amazon business. So we surveyed both of our audiences, our Stratably audience, as well as Consultancy's audience. and asked a number of questions around AVNs, Amazon profitability, their initiatives with Amazon for the year. We heard from 252 brands and a pretty diverse group. So primarily North American and European vendors, pretty evenly split between those two regions. 60% of brands were what we classify as non-CPG. So think hard lines, soft lines, other kind of non-consumable discretionary type categories. Remaining 40% were food and consumable brands, and then very evenly split in terms of size. So all the way down to 10 million and under in annual Amazon sales, and then all the way up to over 50 million, pretty evenly split from a size perspective as well. And we analyzed the data by some of those segments as well. So the benefit of a very large and diverse group is you get a really good understanding, big picture, what's happening with AVNs. But we know, small brands versus large brands, the experience might look slightly different, or CPG versus non-CPG, that might look different. And so our research calls out those distinctions as well. And then maybe the last thing worth adding, that was the quantitative aspect of the study. We contextualized the data in the study with qualitative research as well, both from our experience just advising clients and working with clients on the Amazon business, as well as we ran several share group conversations where we got brands together in a very kind of antitrust safe way to discuss the topic. And so some of the broader context is infused into the research as well. I think data in and of itself can only be so helpful if you don't have kind of the broader context to bring it to life.
Absolutely. It's just a bunch of numbers, unless you find a way to tie it together and to add meaning to it. And that to have such a broad range of brands and size and categories that are included in this study, that's so helpful. This becomes that much more meaningful of a report. As you dug in with the brands and as you looked at the data, was there anything that really stood out to you or surprised you as being really different from AVNs in years past when you're measuring from this current year?
Yeah, I think the most surprising thing to me that we saw both in the quantitative survey data as well as the qualitative data as we're talking with brands is that brands are, I think this year more than ever before, are beginning to put a firmer foot down on trade term increases. And so when brands talk about AVNs and gripe and groan about it, it is most commonly around Amazon's asks with regards to trade terms. So think, your base rate, or maybe you call it MDF or co-op, freight allowance, returns allowance, damages, etc. And typically Amazon comes in with high asks and those rates go up each and every year. I've been doing this for a long time and have been talking with brands each AVN cycle for years now. And what I feel is changing is that the common narrative used to be, terms are going up yet again. We can't stand this. And so we'll try to minimize those increases. This year, I heard more instances of, terms cannot go up again because we really don't have room to give any more to Amazon, or else our business is going to become unsustainable. So in the data, 9% of brands saw a year over year decrease in their trade terms, all in trade terms. Now, that is a very small number, 9%, but I think it's still notable. We don't have the time series of that figure, but broader research would tell me if we asked that, a few years ago, even last year, I think it would be even smaller than 9%. And I think even those brands that maybe weren't able to achieve a year over year decrease, they're really working even harder this year than years past to kind of either keep those terms steady, minimize the rate at which they're increasing, or shifting around the funding. So even if all-in investment stays the same or even goes up a little bit, they're saying, hey, can we move funds away from MDF or co-op as an example, which offers pretty much no ROI, to something that is going to yield an ROI, like Amazon Vendor Services, AVS, as an example? Or can we take things out of trade terms and put it more into our promotional budget to actually drive the business forward? So that was, I think, what stood out to me most was just this clear no one willingly accepted increases in the past, but I think there really has been kind of a tougher fight against those trade terms this year versus years past, as brands are getting to kind of an unsustainable point in the business. And as growth is slowing a little bit. So through COVID, as an example, if growth is on a tear, I think a lot of brands kind of just rode that wave. And now they're kind of really taking a more critical look at what they're investing into the business. Also because it's a much larger business now than it was pre-COVID.
Yeah, I mean, I think when I looked at the report, one of the things that you cited on the trade term negotiations, one of the things you noted was that I think it was 61% of brands were able to avoid an overall decrease in margin. That was, I don't want to sound like I'm hyping this up too much, but that was shocking to me because the consistent narrative is I am constantly bleeding margin to Amazon. And I'm not saying that that's not a real issue at all for so many brands, but 61% did not see a decrease in margins year over year. That was really, really surprising to me and aligns well with what you're talking about of just negotiation around trade terms. And it's not necessarily, I'm not going to bring it down, but if I can shift investment and shift the terms, it really ended up protecting their profitability, which is amazing.
Totally. Yeah. I mean, that's another super interesting note is that even as 91% either kept trade terms steady or saw an increase to trade terms, margins are still relatively healthy, which you're right. It goes completely counter to what you so commonly hear in the industry. Now that means, like I said, brands are getting more diligent with their trade terms. And they're also, I think the bigger point there is they are pursuing very heavily profitability levers outside of just trade terms. And so commonly we asked, hey, how do your Amazon margins compare to your average retail account? About 60% said, hey, our Amazon margins are in line or favorable compared to our average retail account. And so, yes, AVNs are tough. Yes, it's an expensive account to serve. Yes, they're going to continue to ask for more, but margins are holding up well, particularly for those brands that really are saying, hey, the business has gotten large. We know it's important to win here, but we know there is no free lunch. And so how do we really pull any profitability lever that we can, whether that's advertising efficiencies, more profitable assortment, supply chain savings. We cover a number of those in the report, but all in, it's leading to kind of a healthy margin profile, which you're right, Julie, is rather surprising or counterintuitive to what you hear in the industry.
Yeah.
And I would double down further and say, you couple that margin dynamic with the growth prospects of Amazon, which we estimate Amazon is growing about 4 times faster than the retail market. So you have a really, really powerful growth engine that is not all that unprofitable compared to your average retail account. That doesn't happen all that often, right? Where you can kind of have this really key account for both top and bottom line. And so again, I don't discount any of the challenges that are associated with AVNs. And to your point, sometimes it can be an unprofitable account, but for the average brand, it just tells me, hey, you gotta be investing the right amount of time, money, resources, attention into Amazon for both the top and the bottom line.
Yeah, it's kind of going on the topic into the topic of the challenge of AVNs themselves. One of the highlights in your report is the intensity of AVNs. Only 15% of brands saw the AVN process as straightforward and efficient. This part might not have been as surprising to me. Maybe 15%. I'm surprised there's 15% that said it's straightforward and efficient. But 62% highlight that it's difficult and very challenging, and in some cases, still unresolved.
Mm-hmm.
You also know they're not the same. AVNs are not the same for all product categories. It could be based on business maturity, geographic marketplace. Can you walk me through which types of businesses tended to have a more positive AVN experience and what that tells us about Amazon's potential focus and priorities?
Yeah, absolutely. In broad strokes, you hit the nail on the head. Hey, 15%, maybe that's pretty good for a decent AVN experience. So yes, broadly speaking, AVNs are typically going to be challenging, but it really can vary in terms of, the level of asks, the time span it takes to complete, how collaborative or contentious it is. And sometimes that can just vary by brand or vendor manager. There's kind of no rhyme or reason to it, but some higher level commonalities did emerge from the research. First things first, and this seems obvious, but we always have to kind of reground brands in this. And that is that AVNs are going to be easier for those brands that are most important to Amazon from either a growth or a profitability perspective. So the data shows brands that are growing faster than their category, as an example, reported kind of easier AVNs. They were more likely to fall into that straightforward or efficient bucket or the collaborative and partnership oriented bucket. So that means Amazon is kind of likely letting those brands off the hook a little bit more on the term side of it, on the profitability side of it, sacrificing some of that profitability for the growth of that brand. Similarly, if you're already a very profitable account for Amazon and you meet their net PPM, their profitability thresholds, there's not much more for them to ask of you. And so if you're doing exceptionally well in your category from a profitability perspective, you're going to be okay. And that's why, so much of this study shares the data around AVNs, but it also shares kind of the actionable takeaway to, okay, outside of the AVN cycle, you have to be building more margin into the business, because come 2025 AVNs, if you are really improving your margin in a healthy place, you're not going to face as tough of AVNs. That doesn't mean, they're going to be totally easy, but all else equal, you're going to have an easier time. So growth and profitability relative to the category, that's one clear difference. From a region perspective, European vendors tended to have tougher AVNs than North American vendors. The way that I kind of contextualize this is Amazon has done a lot of work over the last couple years to improve their margins on the North American retail business. Tough AVNs over the past couple years is probably one way that they've done that. They've been able to secure greater funding from vendors. And so now North American profitability is actually in pretty good shape. International profitability is still lagging. And so the fact that European vendors had tougher AVNs, that could just be that Amazon is working to get the European or broader international kind of margin profile up closer to that of North America. And then maybe one other thing worth mentioning is that anecdotally, qualitatively, many brands had less formal AVNs this year compared to years past, really due to kind of understaffing and capacity constraints at the vendor manager level. So we know Amazon has cut headcount at the vendor manager level. Return to work policies has kind of thinned out that role, and they haven't been backfilling 100% of the time. And so I'm curious, as we look to 2025 and onwards, I'm curious if that becomes more of a lasting trend of these AVNs do become kind of less formal or less common for some of maybe the mid-sized to smaller brands. Maybe that means more negotiating through the system, which is a whole nother beast. But we did hear that kind of, that was an example of not so much rhyme or reason. Large brands, small brands, all categories kind of here and there would say, hey, yeah, we didn't really have a true AVN this year because we didn't have a vendor manager for 6 months, or our vendor manager was managing too many brands, or whatever it might be. So we'll see if that trend kind of continues and if AVNs start to take a new shape over the coming years.
Well, for the brands, the 62% that reported AVNs is especially challenging. Were there any common themes for those brands that you found in your research? And I'm really interested in like process challenge, as well as what some of the outcomes were in terms of actual trade averages. We've talked about how the trade terms, the negotiation around that was different this year. For those that found it especially challenging, what did that look like in the end for them in terms of trade terms?
Yeah, we ask, hey, what's the most challenging thing for you about AVNs? And not surprisingly, the number one challenge is just getting to favorable terms. And so, like we mentioned, kind of the crux of it is these trade terms in a lot of regards. I mentioned 9% of brands were able to decrease their terms year over year. Most brands therefore saw an increase. On average, brands saw an increase to their total trade terms of 68 basis points. That increase was a bit higher for food and CPG and a bit lower for non-CPG. So it sounds like, I think over a couple different data points, food and CPG had a little bit of a tougher AVN cycle compared to non-CPG. But 68 basis points on average, that, a listener could be listening and say, that sounds small, that sounds big. It's all kind of relative. But in my mind, simple math, upwards of a point on average, if that's happening each and every year, back to our earlier points, you're really going to run into trouble. That is a real challenge. And so that is why more and more brands are starting to wind back those terms to the extent they can. Again, easier said than done, but they're putting up a harder fight today than they did 5 years ago, or even last year. So trade terms is one that, of course, is just the most obvious challenge. I think you mentioned in terms of process, are there challenges? I think the whole process is challenging, right? Amazon is a tough negotiator. They're a unique negotiator. And so particularly compared to those more traditional accounts, a lot of large brands that have been around for a while are really kind of thrown for a loop when they get into an AVN. And so, we always say there's typically two trains of thought. There's the brands that are thrown for a loop and that really kind of push away and resist Amazon's way of doing things. On the contrary, if you're a brand that can kind of lean in, understand the process, and come to the negotiation table meeting their approach, you're going to be best positioned. And that approach is transactional. It is data driven. It is not wining and dining your vendor manager to a successful AVN. And so it's just it's a different approach to negotiating. And we say it requires really a lot of homework to be done. It requires a lot of data gathering. You got to know the data that you're looking at, really know, what am I trying to achieve with AVNs? What am I willing to accept? What am I not willing to accept? How far am I willing to go to get to the outcome that we want to get to? Am I willing to go as far as turning off POs and sacrificing sales? What is the vendor manager going to be looking at? What do I need to be looking at? And so all of those challenges lead us to say, hey, you really got to do your homework ahead of time and do a lot of prep work. And our data shows the more prepped the brand is, the more time they spend to get prepped, the more confident they are in AVNs. It makes sense, but the data confirms it. And still, I think not enough brands do the right level of homework to get ready for AVNs.
You're leading me to my final question here. And if you were to sum it up into one piece of advice for brands as they're prepping for next year's AVNs, taking their own unique learnings as well as the insights you have from this report, what would be the one piece of advice you would offer to brands as they consider looking forward to 2025 AVNs?
If I can have two, I'll give two.
Okay.
Because one is put the actual negotiation aside for a minute and build a healthy Amazon business, right? Because the negotiation is really just whatever comes of the negotiation is a reflection of what you're doing outside of the negotiation. And so trade terms is, as an example, is a big piece of a brand's P&L on Amazon, as is, product costs, as an example. Those are kind of, we want to sell on Amazon and these are the terms. But everyone listening, likely knows that there's those pieces to sell on Amazon and then there's everything else, right? There's content, there's advertising, there's offsite advertising, there's the inventory piece of it and the supply chain piece of it. And you can find a lot of cost savings and you can get to a profitable business in all of those areas outside of trade terms. So again, set the negotiation piece aside and just go through the P&L and really identify, hey, where are some areas we can build sustainable margin into the business? You want to do that anyways because the business needs to be healthy, but you're really going to want to do that and you're going to be glad that you did come AVN season when you're in a healthy spot for your vendor manager and you have an easier time. So like tomorrow, yesterday, as soon as your AVN closes, identify those opportunities to build more margin into the business. And then when it is time for AVNs, you got to do your homework ahead of AVNs to really understand What does my P&L look like? What is my investment ceiling? How far can I go on these terms and everything else that Amazon is asking for? And you have to have data to back that up and just a very clear strategy all the way from, I think that homework, that prep work takes resources from the business analyst pulling the data all the way up to your CFO and your CEO and your CMO as it relates to his or her line items to really be aligned on what role does Amazon play? What are the investment levels that need to align with that role for Amazon? And how do we hold very, very steady in AVNs to get to that outcome? And again, you can't wing it through AVNs and get to that outcome. You're not going to be whining and dining your vendor manager or smooth talking your way into anything. It really just comes down to pretty rigorous work across the board to be able to have success there.
Yep. As with anything on Amazon, there's no easy
That's right.
button. There's no winging it. And you've got to do the front end work, put in the front end investment, whether it's time, resources, or actual financial investment to reap the rewards. So it's the general story across all aspects of Amazon.
Well, yes, I think that's a great point actually to call out, because particularly the topic of AVNs, it is often greeted with, I hate this process and why do we have to go through it? And we get the question like, hey, how do I get out of AVNs?
That's called 3P.
Yes, which has its own host of other challenges.
Exactly.
Totally. So, but you're right, Julie, and we oftentimes just try to gently remind brands, hey, the challenging pieces of it, that is the crux of it. That is where you're going to find your edge, right? And so while other brands are resisting AVNs as much as possible, and maybe therefore not doing their homework and not leaning in the right way, if you can just take it for what it is, this is the process, this is Amazon's way of doing it, they aren't going to change. By the way, they also have a lot of leverage as they are just crushing it in the retail market right now. And so those that kind of lean in, I think, to the challenging piece of it, they're going to end up ahead. And that's true, to your point, that's true in everything, right? Take
all of it.
All of the challenges, marketplace control, Amazon Marketing Cloud as an example, that's an underutilized opportunity, in part because it's kind of challenging to use, right? It's getting easier, but brands are like, yeah, AMC sounds great on paper. And then I dig in and I can't really do anything because it's so cumbersome to use. We would say, yes, wherever it's challenging and therefore brands are not leaning in, that's where you want to lean in, because you're going to end up ahead because of it.
I think that is like the perfect note, perfect perspective to end on. This was a fantastic report. And I'll be really interested as we get closer to the new year, to 2025, to check back in and learn from you how you hear brands are preparing, how they're taking the learnings from their own experience and from this report and applying it, leaning in to the hard stuff so they can get the most out of the process.
Yeah, absolutely. Those years go by fast, right? So AVN takes a while. We're now officially kind of wrapped up with AVNs, just in time for everyone to start again in just a couple months. So yes, it would be great to catch back up ahead of or in the midst of 2025 AVN season.
Well, thank you for the work on the report and for coming and talking to me about it today. It was great talking with you, Claire.
Great talking with you. Thanks for having me on, Julie.